What's up, everyone? It's Scotty with MoneyVest. So in this video, I wanted to go over 6 things to focus on in case there is a recession in the future. We know that recession probabilities are only increasing in the fourth quarter of this year going into early next year, given how high interest rates are. And if they stay higher for longer, these are the 6 things. I call them the recession playbook or the blueprint to follow step by step and make sure that you are checking off every single thing so that you can take advantage of a time period where economic contraction, high levels of unemployment is a possibility, and the markets may give us opportunities. So hope you guys enjoyed this video. Find it helpful. If you do, make sure that you drop a like. Don't forget to subscribe to the channel. Link to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the members only benefits, including intrinsic value spreadsheets, members only videos, options alerts, trade alerts. Everything's going to be included with the trade ideas and setups. Also part of the membership as well. So link's going to be down below, and we'd love to have you on board. I did open up a few more spots. So this right here is a spreadsheet that I put together, that my team and I put together. Basically what this shows us is all the recessions since 1800s. Okay, so we're going back 200 plus years. And we're going back to look at 1857, 1860, 61, Black Friday, the Great Depression, every single one of them. And we basically looked at what the duration of the months was, right, for that recession. We're also going to add the S&P 500 values to better understand how the markets performed during those recessions, to better understand the average loss or the median loss, the drawdown for the market, volatility for the market during those times. But from a very early sort of initial analysis, what we learned is that the median recession lasts for just over a year, okay, 13.5 months. On average, lasts over 17 months. The shortest recession was in 2020. Of course, only 2 months, right? So economic contraction, and the Federal Reserve cuts rates very, very quickly. And then we just see a massive rebound. And the maximum was 65 months. That's a little over 5 years. And that is, of course, the Great Depression over here in the 1870s, right? So 1873 to 1879, very, very significant amount, sort of in terms of duration. So it's obviously all over the place, but in case we see interest rates higher for longer, unemployment maybe starts going up again. Manufacturing payrolls, construction payrolls, they were both down in the most recent print. And if there is any type of economic contraction, as Bill Ackman said, the economy is slowing down faster, what the data suggests. And there's a lot of concerns from a lot of other economists basically mentioning that there is a possibility for economic contraction, for recession, right? Jamie Dimon also mentioned that we are entering into the most dangerous time for the economy as well. So I want you to prepare for it. And these right here are going to be the 6 steps. And before we get there, you'll notice that how do stocks perform around recessions? 6 months after, the percentage of times they're profitable 6 months after a recession is 82%. 82% chance that they are positive 6 months after. 12 months after, so in other words, 1 year later, a recession, the probability for gain is 91%. Okay, so very, very high probability. The markets are higher with an average return of 16%. So double-digit return with a 91% probability, the markets are higher 12 months later. So what does that mean? That means that if opportunities present themselves during or in and around a recession, we need to take advantage of them. And this is the playbook right here. Where did the playbook go? Oh, there we go. This right here is going to be the playbook. So first one, create a budget. If you don't have a budget, I don't even want to talk to you. I'm just kidding. Create a budget, please. That is the most important thing. I'm going to share my spreadsheet in the Psychology of Investing course. And that is going to go over every little single detail, right? Every expense, every income accounted for. Once you start tracking these numbers, most of the battle is already won, right? 90% of the work is complete if you simply start tracking your income and your expenses. So creating a budget, very, very important. You can do it on your phone. You can even do it on your notes app. Simply track your expenses each month and account for everything, right? What I do is I use my credit card, I use my cash, whatever. I keep a track of it. And once a week, I sit down, I put it into my Excel spreadsheet. And then after the month, I review everything. And I basically go over, okay, eating out expenses, transportation, insurance costs, rent, utilities. What was over budget? What was under budget? How did I close on the month, right? Expense-wise. So very, very important stuff. I think it's really important for everyone to create a budget and maintain it and constantly keep track of your income and expenses. Second thing, build an emergency fund. Have 6 to 12 months worth of savings in a fund. stashed away. Now, this is not capital for investing, okay? This is not capital that you simply just use and invest it in the market, right? No, this is strictly for monthly expenses in the unlikely event of someone losing their job. That's it. That's what the emergency fund is for, right? It's for emergencies, okay? An emergency would occur if somebody loses their main source of income, which is the job, right? That's why you dip into the emergency fund to pay for those monthly expenses while someone looks for a new position. So build an emergency fund, 6 to 12 months, ideally longer the better. You want to keep that stashed away. And this should be as liquid as it gets, right? You don't want to be risking this capital in the market because, like I said, it's an emergency fund, right? You don't want to lose your emergency fund. Third, clear all high interest debt, right? Given how high rates are, no credit card debt, right? No any type of auto loans, mortgages that are anything over 6, 7, 8%. Try your best to minimize that as much as possible. That's what I'm doing. I'm trying to minimize a lot of my high interest debt. I don't have a lot of debt, thankfully, knock on wood. I only have some credit cards that I obviously pay off every month. And then I do have a few student loans that are still at over 6% that I'm trying to pay down as quickly as possible because that is an immediate return on your money, right? If you pay down a 6% loan or 7% loan, that's an immediate return on your capital right away because you're saving that interest every single year. So think of it that way and clear all your high interest debt. I think it's going to save a lot of money over the long term, which you can then, of course, allocate towards investment. And the reason why this is so more important right now is because interest rates are high, right? If interest rates were low, like if they were 2 to 3%, then we would have looked at interest rate arbitrage, meaning the rate that you're paying versus the rate you're earning. You can still make a spread. But since rates are so high, right, there's just not even worth doing the calculation and taking on all that risk in trying to generate a higher rate of return than what you're paying because it's just a lot more headache and more hassle because rates are so higher. So for me, clearing all high interest debt, very, very important. Number 4, save up capital. Now, this is different than building an emergency fund. Like I said, this is not for investment purposes. This is, right? Number 4 is. So for me, I want to save up capital. I want to save up more cash and set aside cash so I can actually use that for when the opportunities do present themselves, right? That's going to be the market, stock market, bond market, real estate, whatever it is. If prices start to come down during a recession, it's going to create very, very nice low risk, high reward potential opportunities. So asymmetric opportunities. And that's exactly what we look for. So this is basically kind of getting ready, right? Prepping for the potential deals that may come our way in case there is a downturn. Number 5, keep investing and looking for opportunities. So, of course, now that we've saved the capital, we want to execute, right? It's just saving the capital is only one part of the equation. If you don't do anything with it, the returns are not going to come. So we need to keep following the process. I need to keep looking for deals and keep investing in the market. Nothing really changes, right? Just because the markets are selling out, just because the prices are coming down, doesn't mean I'm going to shy away from investing. If anything, I'm going to turn the dial more towards the aggressive level of start investing even more because prices are lower so I can buy more shares with the same amount of capital. So looking for opportunities and keep investing, trusting the process because, again, I showed you guys the earlier chart that 12 months later, 91% probability the markets are higher by on average 16%. Number 6, play offense and defense at the same time. Now, what does that mean? Okay, so this is going to be a part of our Psychology of Investing course, and you'll actually be able to download a spreadsheet for creating a budget. There'll be a lot of spreadsheets that you can download from the course and play around with them for personal finance. But number 6 is actually, goes a little bit more deeper. It's hard for me to explain just in this video, but offense is generating more income. Defense is lowering your expenses. And when I say play offense and defense at the same time, it's basically suggesting that you want to make sure that your savings rate starts to expand, right? And by expansion, I mean you are looking for ways to generating more income. So for example, I'm going to be looking for generating more income while also living way below my means and cutting out all unnecessary expenses, right? When I say unnecessary expenses, it's really important to highlight the word unnecessary. Okay, and I go into a lot more detail in Psychology of Investing course because, I'm not going to go off of the, long-standing BS advice that you need to save a couple dollars on coffee every single day, not go to Starbucks and make it at home for 10 cents. I think that's complete, excuse my language, but bullshit because that puts you in a mind of scarcity. It puts you in a scarcity mindset, and I don't want anyone following this channel or following our analysis and our work to think that way, right? We come from a mindset of abundance, right? There's a lot of opportunities out there, and I would much rather put you guys on offense and start looking for opportunities to generate more than be in the scarcity mindset that I need to constantly save. Don't get me wrong, saving and looking for deals is very important. So that's why the highlight here is cutting out unnecessary expenses, right? Something that you don't necessarily need at the moment. But if having that morning coffee, fulfills you, that's what it does to me. Like having that morning green tea or coffee makes me more productive. The return on investment is very high. I'll do it. I'm not gonna, save a couple dollars on my morning coffee. In fact, if anything, I go to Starbucks, spend a couple dollars, and actually spend the day there reading books or doing work. So that makes me more productive. So that's why playing offense and defense at the same time is so important. So it's a constant analysis of return on capital that we do. And again, a lot of the analysis is going to be discovered in our psychology of investing course. I don't have a lot of time to go over everything here, but this is a topic that I go into a lot more detail in our course. Now, number 7, network. And that's actually one of the cool things about our community as well, because we've got so many people from so many different backgrounds. We've got engineers, doctors, medical professionals, people from all facets of the world focusing on different things, experience with different things. So, of course, our community is one place where you can network, and then LinkedIn is another one. But just making sure that your resume is top notch and you are networking with people in your industry. In the unlikely event that something were to happen to your job, then you are well situated in another position fairly quickly because of the networks that you've built. So these are the 7 I would consider very, very important things to focus on during a recession, and this hopefully kind of prepares you for of course we'll find out in the next 3 to 4 quarters whether we are in a recession or not, and if so, how severe it ends up being. But hopefully this kind of prepares us and keeps us aligned and what needs to be done in case there is one. So hope you guys enjoyed this video. Let me know your thoughts down in the comment section below. As always, make sure that you drop a like, and don't forget to subscribe to the channel, and link to our Discord and Patreon is going to be down below. And as always, happy investing, and I will see you all in the next video.